I don't mind if you guys talk during the lecture, but whisper in the person's ear. Because it's distracting, and actually the camera will pick up your conversations if you're too loud. So try to be quiet, and make sure when you do the presentations that you speak really loud so that people at the end over here can hear what you're saying.
Yep.
Okay, thank you.
All right, so this is 4.8, an example of the DuPont equation. Given in the problem, the company is Rangoon Timber Company, and the values that it gives us are net sales over total assets, which is 2.23, ROA, which is 9.69%, and ROE, which is 16.4%. The question is, what are Rangoon's profit margin and debt ratios? So, solution, by using the given, by using what's given, we can start with the equation for obtaining the ROA, which is net profit margin times total assets turnover. Then we can move the equation around to put total assets turnover underneath ROA by dividing both sides. So profit margin equals ROA over total assets turnover, which is a kind of just another way of writing this equation. So we know ROA, we know total assets turnover value is 0.969% and 2.23, which is the fraction here, which gives a decimal that you have to convert into a percentage, which is 4.35% here. Also, same like we did with ROA, with return on investment, that equals ROA times the equity multiplier. Once again, turning the equation around, the equity multiplier becomes equal to ROE divided by ROA. Now that we have, never mind, that's not there. But ROE over ROA, we know ROE is 16.4%, which is here. ROA is 0.0969%. We divide those to get 1.69. The debt ratio formula is debt ratio equals one minus equity over total assets. Once again, flip the equation around, equals 1 minus 1 over equity multiplier. And then we just plug in the numbers, which is for this, which is equal to 1 minus 1 divided by 1.69, which is 0.41 for the figure of Rangoon's profit margin debt ratios.
I did future value, so I have two problems over there. We did this like in accounting too. Most of them know how to do that. It's like if you invest something and it comes back out later, how much it's worth. So in this one, the present value, which is what you invested initially, was $2,700. You have a 5% interest that compounds semi-annually, so it's twice a year it compounds. And so the equation, these are all the kind of factors that are written out. So it's 2,700, you expect 5% each time it compounds for 4 years, does it twice a year. And so the equation is the present value times 1 plus the investment rate over the amount of years, and then to the power of the amount of years and how many times it's compounded. This is how many times it's compounded. So in this one, it'd be 2,700 times 1 plus 5% over 2 to the 8th power, which comes up to this, and it equals 3,289.69. Basically, I need is this equation. And then the second one was the same problem, the same issues, but just different numbers. It's 1,000 on the present value, 5.2% on the rate, 2 years, and it's compounded quarterly, so 4 times a year. You plug it all in, and it comes out to 1,108.86.
Alright, so I have a 5.1, which is kind of similar to Cooper's, so it's a future value. So you have someone that's putting into a mutual fund. So the present value right now is $25,000, and he's expecting a return from investment at 8%, and this is every year, and the number of years is 10, and your value of investment after 10 years is obviously your future value, and then this is the equation right here, so you have your future value of 10 years equals your present value times 1 plus your interest to the nth power. So when you plug in all these numbers, you get 25,000 times 1.08 to the 10th power, which comes out to be 53,973.12. And then my next one is 5.9, which is the rule of 72. And basically, to sum up this rule, it says that this is the time to double your money approximately equals 72 over your interest or your rate of return. And this is your equation. So in this problem, it gave me a rate of return at 10%. So if you just plug that into this equation, it's 72 over 10. And it should be about 7.2 years to double your money.
Okay, and then I did 5.3, which is basically the same one that they did, future value money, when you have $5,000 with a 7.5 expected return on investment for 4 years, and it's compounded semi-annually. Do the same exact thing that Cooper said with the equation, PV times 1 plus I over M, and you multiply M by N. And then, so you take $5,000 and you multiply it by 1 plus 0.075, which is 0.075%, divided by 2. And then once you get down here, you do 1.0375 to the 8th power times by 5 and get $6,712.35. And then I also had number 5.4, which again, it's an exact replica of Cooper's. You start out with $2,000, you have an expected return of 8.5% for 3 years. You do the present value times 1 plus the investment times N, so the number of years, 2,000 times 1.085 to the 3rd power, and in 3 years you'll have $2,554.58.
I did 4.4. They use Montiff Enterprises as the company for an example. They give you net sales, gross profit, earnings before interest and taxes, and the net income. So as to calculate the cost of goods sold, gross profit margin, operating profit margin, and net profit margin. For cost of goods sold, you subtract the gross profit from the net sales, which gives you roughly $9 million. For the gross profit margin, you do gross profit divided by net sales, which gives you 31.4%. Operating profit margin is earnings before interest and taxes divided by net sales, which once you calculate it gives you 19.67%. And then for net profit margin, you get net income divided by net sales, which ends up being 6.6%.
My question, it's pretty simple. It's on debt to equity ratio, which is a simple ratio, just debt over equity. If you remember the accounting equation, this should come as no surprise that equity is equal to total assets minus total debt. So then we just plug in these numbers. These were given to us at the beginning of the problem. So debt was $20,885,753, and then you take that, so our total asset, total debt, and that comes out to a 0.41. And then this equity multiplier basically just means add 1 to whatever you get as your debt to equity ratio. So then that's 1.41. Just a little additional information. Then they wanted us to do this EBIT, return on assets, which is just equal to EBIT, which is earnings before interest and taxes over your total assets, which were both given to us actually. So then you just plug it in, and that's 36.02.
I did 5.1 and 5.2, and they're also on future value and present value. For 5.1, the problem already gives you the present value of investment and the interest rate and the number of years. And so you just plug it into this equation, and it's basically just 10,000 times 1. Oh, that's supposed to be a plus there. 0.09 to the power of 5, and then you get 15,386 and 24 cents. And then for 5.2, you find the future value, the present value. And so then it already gives you how much they're expected to pay at the end of the 6 years. It gives you the 6 years, and then it gives you the interest rate. And then to find the present value, it is just the future value divided by 1 plus the interest rate to the power of the number of years. And so that's 50,000 divided by 1 plus 0.07625 to the power of 6 years. And at the end, you get 32,853.84.
I did 5.4. So it tells you that the investment today is $2,500, and then the amount to be received in the future is $3,000, and you have to look for the return on investment. So the formula is present value times 1 plus the return on investment to the amount of time. The amount of time was 3 years. So since you don't have a rate, you have to switch everything to the other side. So you do 3,000 divided by 2,500, and then you get 1.2. And then once you do that, you find the cube root, 1.2. You subtract 1, and you multiply it by 100, and then you get 6.27%.
Want to go over here, 3.5?
3.5 over here.
Oh.
So for my problem, it's just asking to find the net working capital, and to do that, you just subtract the total current assets minus the total current liabilities, and you'll get the net working capital. So they gave us a cash and market securities, which is a total current asset, account receivables, inventory, and other current assets. These are the values, which all equal to $11,966,630,000. And for the current liabilities, it's accounts payable and notes payable, which all equal to $5,311,020. So we just subtract these two together, you get $6,655,600.
So I did 3.6, so mine goes right off of his. So for his, he found the book value, net working capital. So basically the book value is the value according to the company's own financial statements. So it's pretty much how they got it through taking their assets and subtracting their liabilities. So my question has 2 parts. So the first part is to find the net working capital using market values instead of book values. And then the second part is to find the percentage change in net working capital when you switch to market values from book values. So starting with finding the market net working capital, you have to take the market value of the inventory, and the question tells you that the market value of the firm's inventory is 20% below its book value. So you take its book value of the inventory and you multiply it by 0.8, 80%, because it's 20% less than the book value, and that gives you the market value of the inventory right there around $5 million. And then the market value of the receivables is 25% below the book value of the receivables, so 75% of the book value. So you can multiply that by 0.75, and that gives you the market value of the receivables. And then you have your total current assets over here by adding those, adding that plus the receivables. And then you have your total liabilities over here, and then you subtract the liabilities from the assets with the market values in play, and you get a market net working capital of about $4.6 part two is to find the percent change when you start using the market values. So you take the market net working capital of 4.3 million, and you subtract the book value net working capital that was in 3.5, so about 6.6 million, and then you divide it by the book value of the net working capital from 3.5, and that gives you negative 34.5%. So it's there's a 34% difference when you use the market values compared to the book values. It's about 34% lower.
So I had 415, which is find the cost of goods sold. So for the liability, it gives us all these numbers right here. The liabilities is 450,000, quick ratio is 1.8, inventory turnover ratio is 5.0, and current ratio is 3.5. So in order to find the cost of goods sold, you first have to find current assets, which is current ratio times current liabilities. This gives us 1.5 or 1.5 million, and then once you have the current assets, you can then find the quick ratio, which is current assets minus inventory over current liabilities. So once you work all that out, you multiply the current liabilities by the quick ratio, and then subtract on the other side, and then you find the inventory of 765,000. And then once you have the inventory, you can find inventory turnover, which is cost of goods sold over inventory. So the inventory turnover from up here is 5.0, which was cost of goods sold divided by 765,000. You multiply those together to get your cost of goods sold of 3,825,000.
So the question is 3.6, what was the cash flow to investors from operating activity during 2017? So to get your CFOA, your cash flow of operating activities, you take your EBIT, which is your earnings before interest and taxes, minus current taxes, plus non-cash, and then you have CFOA equals EBITDA, which is earnings before interest, taxes, depreciation, and amortization, minus current taxes, and your EBITDA is 7,300. Sorry, 7,325, and then your rate is 0.35, which is 35%. That's your tax rate, and then take the 7,325 minus 1,023,285, which is it's your depreciation and amortization, and then minus your interest expense, which is 1,155,378. Sorry, I read that wrong. And then you do that, and then subtract that from your EBITDA, which gives you 5,507,613. So I got 7,000. So not that I'm tired.
So I did 2.6.1. Basically, you lent $100 to a friend for 1 year at a nominal rate of interest of 3%. Inflation during that year was 2%. Did you experience an increase or decrease in purchasing power of your money? How much did it increase or decrease? So we take this equation. We set in for I the 3% nominal interest, and for the change in P, the 2% of inflation, and we got 0.98% for the change in purchasing power for your money, which increased slightly by less than 1%.
Did chapter 1.5, which is pretty random, and so for cash flows, what is the appropriate decision rule for the firm considering undertaking a capital project? And the appropriate decision tool for capital is specifically that a firm should undertake a capital project only if the value of the cash flow exceeds the cost of the actual total project.
flows. And for this problem, you're supposed to be computing the cash flow invested in net working capital, which is CFNWC, and also computing cash flow invested in long-term assets, which is CFLTA. So it's for the equation, it's going to be total current assets for the current period minus total current liabilities for the current period. And then on the other side, it's going to be the previous period. So it's going to be total current assets for that period, and then total current liabilities, and then subtracting that will give you negative 16,467. And then that'll be for the computing cash flow invested in net working capital. And then now to the next one for the cash flow for long-term assets. So long-term assets in current minus long-term assets in previous. And then on the other side is going to be the same thing, long-term assets in current, and also subtracting the previous, and that will give you the cash flow for long-term assets.
So I had problem 2.28, and so basically the whole idea is you borrow $500 from a roommate, and you agree to pay her back $500 plus 7% for nominal interest in 1 year, and then you assume inflation over the life of the contract is expected to be 4.25%. What is the total dollar amount you have to pay her back in a year, and what percentage of the interest payment is the result of the real rate payment? So first, finding out what you have to pay back in a year, you just do 500 times the nominal interest rate percentage, so that's $535 in 1 year. And then given that the inflation rate is 4.25%, you can use the Fisher equation and plugging in for the I and the R and the change of P to the T, you get that 13 or 3.79.6% of the total interest payment is real interest rate.
I did 4.19, and it was all about finding the debt to equity ratio. So they give you the debt ratio as 0.56. First you need to find the equity multiplier, which is total assets over total equity, which is also 1 divided by total equity divided by the total assets. So it's 1 over 1 minus the debt divided by total assets, which is 1 over 1 minus 0.56, which gives you 2.27. And then to find the debt to equity ratio, it's the equity multiplier, which we just found, minus 1. So you do 2.27 minus 1, which is 1.27, which is going to be your debt to equity ratio.
So I did 4.21 over here. It's asking you to solve for the gross profit margin, the operating profit margin, and the net profit margin. All are pretty simple equations. So the gross profit margin is net sales minus your cost of goods sold over your net sales. All these values were already provided in the problem at the top of the board here. So you just plug in those numbers, and then your gross profit margin equals out to 51.2%. Your operating profit margin is your EBIT over your net sales, which equals out to 19.1. Again, you're just plugging in those numbers. And then your net profit margin is your net income over net sales. Again, you just plug in those numbers and you get 12.6.
Okay, so I did 3.22, and we had to create an income statement for Sosa Corporation. So they recently reported an Ebit of $31.3 million and a net income of $9.7 million. The company had $6.8 million in interest expense, and average corporate tax rate was 35%. What was its depreciation and amortization expense? So for the Ebit, you write the $31.3 million, and then you subtract. Well, no, you don't do that first. It comes after. So you just input the given, which is the interest expense and the tax rate, and then you just end up finding whatever was left, and
for 3.26 to find the cash flow. So refer to the information given in problem 3.21. What is the cash flow from the operating activity from limits rental? So to get the cash flow from operations, you just add the net income and depreciation, and then you get that number.
Three point 1.13.
I can go.
3.14.
Oh, okay, he's done.
So, I have cash flow and this is, where is it? I think I did this wrong, I'm not really good at explaining. So you have the current assets from the year ending in 2017 here, and the current assets for ending in 2016, which is here. And then you have your liabilities from both those years, which is 17 is here, 16 is here. So you would find your differences between each one by subtracting assets and liabilities from 17 and 1, and then 16, 16. And you would get these two differences, and you would subtract them from each other to find the cash flow, the net working capital for 2017, which is 284115. And then this one I didn't really get. It was assets in terms of depreciation, but for the solution, it just subtracted both of them. The long-term assets, so the bigger asset was subtracted from the smaller asset, and we gave 20545. So we can go without because I didn't really get it now.
So I did 4.7, which was about leverage ratios. So we're trying to determine the company's equity multiplier, the debt ratio, and the return on equity. So we're given a couple values, which are the debt to equity ratio, the ROA, which is return on assets, and also the total equity. So first I started off by finding the equity multiplier, which is really easy. You just add the debt to equity ratio, which is given to you, to 1, so it turns out to be 2.65. And then the next thing I found was the return on equity, which is a little bit complicated because you have to find the net income. So you're given the total equity, which you use to find ultimately the net income. Once you have that, you do net income over total assets, and then you get the ROA, which is 29.9%. And then from there you can do the debt ratio, which is just 1 minus equity over total assets. So then you end up with 0.623.
Alright, so I did 4.12 and 4.14, and for 4.12 the question's asking for the earnings per share and the price earnings ratio. So this is pretty straightforward. They give you like all the numbers you need. And then to find your earnings per share, you divide your net earnings by your shares outstanding, and then you get 2.55. And then to find your price earnings ratio, you use the number that you got from your earnings per share, divide that by the price per share, and then you get 21.26. And then 4.14, it's asking for the current ratio. But to find that, you first have to find your quick ratio, which is your current assets minus your inventory divided by your current liabilities. So you do the math, and the numbers are all given, and then you get your current assets. And then the current ratio formula is your current assets divided by your current liabilities. So you're going to use the current assets number that you found through the current ratio, divide that by the current liabilities, which is given, and then you get 2.49.
4.12.
Here, take a picture of this one.
Okay, so I was in charge of doing problem 4.3, and so if Newton Manufacturers has an accounts receivable turnover of 4.8 times and net sales of 7,812,379, what are its receivables? So we use the accounts receivable turnover ratio, net sales over accounts receivable, we plug in the values we have, 4.8 for accounts receivable turnover and 7,812,379 for net sales. We rearrange the equations to work in our favor, so we multiply accounts receivable on both sides and divide 4.8 by on both sides. And then we get our accounts receivable as 1,627,579.
4.5.
The problem I had was 4.5 for ABC companies. We needed to find what the value of the accounts receivable was and then the value of its net sales. So what was given was accounts receivable turnover is 15, total asset turnover is 4.5, and then total assets in general is 1 million. So then to find the value of the ABC account receivable, you need to take the AR turnover and then the total asset turnover and divide it, and then you get 3.333. And then to find the accounts receivable, you'll take that total assets and divide it by that to get 300,000. And then for net sales, you multiply 4.5 by the 1 million, and then you get 4,500,000.
So I had questions 29 and 30 from chapter 4, and it's going to give you a lot of numbers as givens, and what it wants you to do is it wants you to find the net income and net sales, and it also wants you to find the firm's debt to equity ratio. So for net sales, we're actually going to have to calculate the net income first. So what we're going to do is we're going to just take two of the numbers that they gave us, and we're just going to multiply them together, and then we're going to get a number around 10 million. So we're going to take that number, and then in order to get net sales, we're going to use that number around 10 million divided by the profit margin, which is given, and we're going to get a number around 88 million. For total equity, we're going to use the net income again, and then divide that by the ROE, and that number will give us something around 48 million. For total debt, we're going to do total assets minus the total equity. We're going to use two givens there, and we're going to get a number around 39 million. And then finally, for the debt to equity ratio, we're going to just do debt divided by equity. And we're going to do 39 million divided by 48 million, and that's going to give us 81.6%. And then moving on to question 30. So it actually wants us to draw from a balance sheet on this question, but obviously I don't have enough room to write that entire thing down. So what it wants is the current ratio and quick ratio, and it also wants us to solve for the firm's days sales outstanding, total asset turnover ratio, and fixed asset turnover ratio. So for A, for the current ratio, we're just going to do current assets divided by current liabilities, and we're just going to pull from the balance sheet for those numbers. So when we divide those two numbers, we'll get 2.04 times. For the quick ratio, we'll do current assets minus inventory divided by current liability. And then we're just going to pull from the balance sheet again. Using all those numbers, we're going to get 0.889 times. For B, we're going to do the DSO. So that's going to be 365 divided by net sales divided by accounts receivable. And that's going to give us 12.69 days. For total asset turnover, we're going to do net sales divided by total assets. That's going to give us 3.45 times. And for fixed asset turnover, we're going to do net sales divided by net fixed assets, which is 5.71 times.
James is.
Just turn it on and then I'll do the.
So confused by how we have to figure out how to navigate around the meeting.
Well, we're presenting chapter 1, which is fundamentals of corporate the financial manager in the firm.
The learning objectives are 1, identify the key financial decisions facing the financial manager of any business. 2, identify common forms of business organization in the United States and their respective strengths and weaknesses. 3, describe the typical organization of the financial function in a large corporation. 4, explain why maximizing the value of the firm's stock is the appropriate goal for management. 5, discuss how agency conflicts affect the goal of maximizing stockholder value. And 6, explain why ethics is an appropriate topic in the study of corporate finance.
So yeah, the role of the financial manager is to maximize shareholder wealth and stakeholders, our managers, employees, suppliers, creditors, and the government. It's all about the cash flows. Positive residual cash flow may be paid to firm owners as dividends are invested in the firm. The larger the positive residual cash flow, the greater the value of the firm. And negative residual cash flow over the long run leads to bankruptcy or closing of a business. And then this shows the cash flows between the firm and the stakeholders and owners. So yeah, that's awesome. There's 3 fundamental decisions in financial management: capital budgeting, financing, and working capital. And this is the balance sheet. Shows working capital within management decisions, the capital budgeting decisions, and financial decisions, both within the long-term debt and the stockholders' equity.
So the forms of business organization: sole proprietorships, partnerships, and corporations. So sole proprietorship, owned by a single person who is financially responsible for the actions and obligations of the business. Some of the advantages are easiest to create and control, to dissolve, and the right to all profits. And some of the disadvantages are the owner's personal assets are at risk due to unlimited liability for firm obligations, equity only from owner or business profit, business income taxes as personal income, and difficult to transfer ownership. For partnership, A partnership is a business owned by more than one person. One or more of them is financially responsible for the actions and obligations of the business. The advantages: limited protection of owners' personal assets, owners' limited liability for firm obligations, more sources of equity, more sources of expertise. Some disadvantages: shared control and shared profit, harder to dissolve. And a corporation is a business owned by more than one person. None of them are financially responsible for the actions and obligations of the business. The corporation is responsible for its obligations and actions. Advantages are protects personal assets, no shareholder liability for business, easiest to change ownership, greatest access to sources of funds. And some disadvantages: it's most difficult and expensive to establish, dilutes individual control over the firm, and overall higher taxes on income for single owners.
So the two hybrid forms of business organizations are limited liability partnerships, or LLPs, and limited liability companies, or LLCs. Both combine limited liability with tax advantages of a partnership. So these are just some characteristics of different forms of business organizations. This is the sole proprietorship, the partnership, corporation, limited liability, partnership, or company. And some of the factors include cost to establish, life of entity, control by founder over business decision, access to capital, and so on. Managing the financial function, the organizational structure: the CFO, or the Chief Financial Officer, is responsible for the quality of the financial reports received by the CEO. The positions reporting to the CFO are the treasurer, the risk manager, controller, internal auditor, and then the external auditor, audit committee, compliance, and ethics director. And yeah, that's just.
So the goal of the firm is to maximize market share, maximize profit through accounting profit. Though accounting profit differs from economic profit, profit earned may not equal cash received. Maximize value of the firm's stock and management decisions regarding cash flows and stock prices. This is also just showing how it can affect stock prices through economic, business, and the firm. Agency relationship is created when the owner, principal of business, hires an employee and agent. The owner surrenders some control over to the enterprise and its resources to the employees. Separating ownership from control creates the potential for agency conflicts. So it's talking about relationships between the stockholders and the firm's hired management. Ownership and control: large corporations, shared ownership among many shareholders may result in relatively little control over management, and shareholders own the corporation, but managers control the firm's assets and may use them for their own benefit. So yeah, this just kind of goes into agency costs. So yeah, the Sarbanes-Oxley and regulatory reform. It's helping governance of corporate spending and costs. So it's more effective monitoring of managers' activities, programs that promote appropriate behavior by the managers, and penalties for executives who do not fulfill their fiduciary responsibilities. The reform also ensures greater board independence, establish internal accounting controls, establish compliance programs, establishes an ethics program, expand the audit committee's oversight powers. So it basically creates more a check and balance within the corporation. Why is ethics important in business? Well, ethics are society standards for judging whether an action is right or wrong. Business ethics are society standard for acceptable behavior applied to business and financial markets. Examples are agency costs, employees' unacceptable use of an employee's computer, A conflict of interest would be a mortgage contract which a home buyer is unlikely to fulfill, but earns a mortgage broker more money. Information asymmetry. Seller knows about prior damage to vehicle, but the potential buyer does not. And we offer a class here, business ethics. Everyone should take it. It's awesome. So basically, it goes down to the business behavior, the ethical behavior, and then the consequences of unethical behavior as well. And this is just a framework for ethical conflicts. And this is just the copyright from the book we use. Chapter 2.
Okay, so we are chapter 2, which is the fundamentals of corporate finance. Where in this one you learn about financial systems and level of interest rates. Okay, so first are the learning objectives of the chapter. So you're going to describe the role of the financial system in the economy in 2 basic ways in which money flows through the system. Discuss direct financing and the important role that investment banks play in this process. Describe the primary, secondary, and money markets. Explain the special importance of secondary and money markets to business organizations. Explain what an efficient market is and why efficiency is important. Explain how financial institutes serve the needs of consumers and small businesses, and compute the normal and the real rates of interest, differentiating between them.
So with describing the financial system, it's made up of like financial assets to be traded for, like stocks and bonds. And then in terms of the financial institutions, there's examples like banks, credit unions, insurance companies, and finance companies. The financial system is pretty competitive because only small amounts of money are borrowed but loaned in large amounts. And basically with the financial system, it directs money all around. So if you look at the next slide, you'll see how the funds flow through the financial system between borrowers and savers and lenders and savers. And so that's basically the main and basic function of the financial system, is to move money around the lenders and savers with the financial institutions. If you see here,
you'll see the flow of money through the financial institutions and the financial markets. Examples of borrowers and spenders would be like households, business firms, and the government. Lenders, savers would be household, business firms, and government again. So it's just a big cycle of money movement all around. In terms of direct financing, it's usually big bucks and big spenders because the minimum transaction is $1 million. So these are mainly contract based. And then it's mostly investment banks and money center banks that usually have all the money because they're dealing with financial contracts and distributing new debt and equity to the people that are using them. The types of financial markets would be primary and secondary markets, over-the-counter markets, and money and capital markets. So an example of a primary market would be like a wholesale, like where new securities are issued and sold for the first time. Second market would be the retail.
Okay, and so then there are key concepts like marketability and liquidity. So marketability is ease with which a seller or buyer for an asset can be found. Liquidity is ease with which an asset can be converted into cash without loss of value. Financial markets increase this marketability and liquidity of securities, and they also lower the cost of making transactions and make participants more willing and able to pay higher prices. Example, Scott Trade and E-Trade made it easy for us to buy a share of Exxon or a bond from Coca-Cola. So next we're going to have brokers and dealers. These concepts have to do with a broker brings a seller and a buyer together but does not buy or sell in the transaction. So they don't have to worry about the risk. And then a dealer participates in trades as a buyer or seller using her own inventory of securities. The dealer does take on the risk, unlike the broker. And then there are exchanges and over-the-counter markets. An exchange is where the seller and the buyer meet to conduct transactions, just like the New York Stock Exchange is Chicago Board Options Exchange. Over-the-counter market, these are is when dealers conduct transactions over the phone or via computer, for example, NASDAQ. And then with money and capital markets, the money market is a market for low-risk securities with maturities of less than 1 year, like treasury bills and commercial papers. And then there's the capital market, which is a market for securities with maturities longer than 1 year, which is bonds and common stock. And then in the public and private market, these are organized financial markets where the general public buys and sells securities through their stockbrokers. They involve direct transactions between two parties, often called private placements. The advantages of this is faster, lower transaction costs, but the disadvantages is that it cannot be sold in public markets because they lack the SEC registration, and the dollar amounts that can be raised tend to be smaller. So this shows an example of the selected money market and capital market instruments. Basically, how to calculate these costs. And then the futures and options markets, they're derivative securities derived from their value from some underlying asset. And then an efficient market is one in which current prices of securities incorporate the knowledge and expectations of all participants. They are correct, but securities are not overvalued or undervalued. Participants are confident they pay or receive intrinsic value of security, and operational efficiency, which is the extent to which transition costs are minimized. Information or efficiency, the extent to which security prices reflect all relevant information. And then the last part of this is the strong form efficiency, the semi-strong form efficiency, and the weak form efficiency.
We got market efficiency. Suppose markets such as the New York Stock Exchange are more efficient than private markets due to the information provided by participants and effective regulation. Indirect financing banks, insurance companies, how about borrowers and savers? Financial institutions and the services. Financial institutions provide lending and borrowing opportunities at the retail level, small customers and wholesale level for larger customers. Efficiently collect funds in small amounts and lend them in larger amounts, tailor loan amounts and contract terms to fit the needs of the customers, corporations, and businesses. Financial institutions and their services continued. Types of financial institutions are banks, life and casualty insurance companies, pension funds, investment funds, business financing. There's like, determinants of interest rate levels are the real rate of interest, loan contracts and inflation, the Fisher equation and inflation, cyclical and long-term trends in interest rates. Interest rates. Interest rate is the fee for borrowing money expressed as a percentage of a loan. Nominal rate of interest is the interest rate we observe in the marketplace. And the real rate of interest is the interest rate that will exist in the absence of inflation. Equilibrium rate of interest is a function of supply and demand. Savers supply more funds at higher rates, borrowers demand less at higher rates. Equilibrium is the rate at which the quantity of funds supplied equals the quantity of funds demanded. I think it's in the chart. Inflation in loan contracts. Lenders want the interest rates in loan contracts to include compensation for the inflation predicted to occur over the life of the contract. Compensation for the expected inflation adjusts loan rates to offset the higher prices for goods and services expected to exist when a loan is paid and understand the money. Fisher equation is cyclical and long-term interest rate levels. Interest rates tend to rise and fall with changes in the rate of inflation. Rates tend to rise when the growth rate of the economy increases and tend to fall when the growth rate of the economy slows. Interest rate, business cycle, and inflation. Interest rates tend to follow the business cycle. Interest rates tend to increase during an economic expansion. Interest rates tend to decrease during economic contractions. And copyright.
That's it.
Can you turn off that camera? So I'm gonna finish up with these guys, and we're done. Okay? Oh, you?
Yes.
Okay, did I miss you?